In this video, I'm going to provide a defense for the held-to-maturity treatment of financial assets on balance sheets. They are listed at amortized cost, not fair value. The observation of that may seem unique to banks, but it is not. It is every single company that's publicly traded has this on their balance sheet, and it's never been questioned. And it's never been implicated in a failure. In fact, it's probably not the cause of the failure at all. So we'll put a defense for that up. And I have two observations on here. The first one is every system, every policy, every structure in place or that you can think of has both advantages and disadvantages. There is nothing that you can list that has only advantages. Everything has its own set of disadvantages. And held to maturity is being pointed out right now that it has disadvantages, is that the solution to it should be to list those assets at fair value. And whenever we come across a problem and we list all of the problems that we have, we say, well, a solution must be found to these problems. We must get a solution to these problems. But I refer you to observation one. Every system, every policy, every structure has both disadvantages and advantages. So when looking at the disadvantages of held to maturity, we're thinking, well, there must be some regulation. What if it were listed at fair value? This wouldn't have happened. Well, we're going to see what a big problem that is. And in listing it at fair value, we'll think about, well, what would be the disadvantages of that? Because every solution that is brought into this world for any problem that exists, every solution brought into this world comes pregnant with its own problems. So any solution will have its own disadvantages. So we'll look at those. Observation number two, if A has existed during multiple events of B and B prime, A is not the cause. So let's say that we observe events of B, bank failures. And let's say we observe events of B prime, not bank failures. And A is present. In both of these conditions, A cannot be causal. What we're missing is some third variable, is some other variable at play, but A cannot be the cause. So held to maturity is being pointed out as, well, if they weren't listed at fair value, something would have been done. No, something else would have happened. It's just some other crisis would have happened. It's not held to maturity's fault at all. One of the questions that I've received is, it seems so obvious. How come nobody saw this coming? I mean, credit rating agencies had a solid credit rating on it. As I explained on the weekend, Moody's beginning a week before that was telling SVB, look, there's a downgrade coming. And then on Tuesday, they gave them the customary 24-hour notice that, okay, now we are going to downgrade you. So they were going to downgrade them. It's just SVB was trying to get in front of the downgrade. So the idea that Moody's had an A rating on them up until the day they failed, well, that's not quite true. Moody's didn't have to tell SVB anything. That's a courtesy thing in the industry. They didn't have to say anything, and they would have just downgraded the debt on Wednesday night. SVB tried to get in front of it because they knew that it was coming. But among other analysts, how come you didn't see this coming? Let me give you an example of how absolutely easy it is after the fact, but how absolutely difficult it is before the fact to pick out what's going to fail. Let's say we observe a person, and let's draw this person with my art degree. There's this person, really happy because this person has a substance abuse problem. We're talking heroin, we're talking alcohol, and we're talking LSD. Anything that this person get inside them, they've got. And they've been doing this for a while. And one day, let's see if we can draw this out. There. We find them dead on the ground. And we say, wow, that makes, actually, hang on here. Let's get a broken leg back there. They say, well, that makes sense. I mean, the way this person lived, I mean, anybody saw that coming. It was a crash course with death. They were on a collision course. Not a crash course. They were on a collision course with death. I mean, look at the way they lived their lives. But not everybody who lives their lives like this ends up like this. Some end up in rehab, some turn it around. But you cannot, at any given point, look at an individual and say, aha, you're going to OD, you're going to OD, you're going to OD. All we can say is you have all the footprints of it, but we don't know. Only after they OD do you look back and say, wow, kind of obvious, isn't it? But before the fact, very difficult to do. So looking back at why SVB failed, all the footprints are there. The reason why they failed is clear. But before the fact, it was not a sure thing that they were going to fail. They could have implemented some risk management at the very last minute. Their share sale could have happened without spooking the market. It wasn't guaranteed that they were going to fail. And even if you recognized some of the issues with them, you would have said, well, I can see this. Clearly they can see this. They must be working on it. They must be doing something. It's very difficult before the fact to predict who is going to fail. But once they do fail, the footprints look really, really obvious, so that we ask ourselves, how come nobody saw this coming? Okay, let's move forward here. Okay, to help us understand why something would be listed at amortized cost, it is useful to find another category of assets that are listed at amortized cost and not fair value. So let's go to a manufacturing firm. They have long-lived assets. In other words, assets that they plan to hold to maturity, whatever that maturity is. Its useful life, they'll hold it to maturity. We'll call that T. So they'll buy an asset at a certain price and they'll depreciate it down to T, typically in a straight line methodology. That is the carrying value of the asset. Each year they recognize some depreciation for its useful life. So this represents the economic use of the asset over a period of time. You paid $1 million for an asset that's going to last 10 years. We'll charge $100,000 to income each and every year. But everybody knows in the first few years, fair value drops off significantly. That after 2 years or 3 years of carrying an asset, the carrying value of that asset far exceeds the fair value of that asset. Everybody knows that, but nobody makes a big deal about it. Because depreciation represents the matching of the costs with the revenues as incurred. We're going to buy this asset. It's going to last for 10 years. We don't plan to sell it in a year and a half just because the market for this asset is hot. We need it to produce an output. We're not in the business of buying and selling equipment and arbitraging equipment. We're buying it with the intention to use it in our business until it has no salvage value or until it has to be replaced. And yes, its fair value at times will either be below the value of the equipment. In the early years, most definitely. In the later years, the fair value may be above the carrying value of our equipment. This is very common with buildings. When you own a building, you can depreciate that building over time. And if you own that building for 40 years, maybe the carrying value of that building on your balance sheet is way below what it's really worth. Its fair value is way above. Or you may have a fleet of trucks that after 2 years you would say, clearly, these trucks are not worth what you're listing them for. They're worth a lot less. But we don't make a big deal about it because we get it. You're not in business. You're not in the truck business. You're in the business of using trucks to get something else done. Right? So we make no big deal about this at all. Well, banks have held to maturity assets. In other words, they have long-lived assets as well. They hold these portfolios not because they're in the business of buying and selling the assets of these portfolios, but because they're holding them for the output it produces, the stream of revenue that it produces, or the yield each year that it produces. And yes, there are times where the fair value will be less than the carrying value, much like the equipment on this side, and there are times the fair value will be above the carrying value, much like the equipment on this side. So this is nothing more than the amortization of a long-lived asset over its useful life. And the key here is that it is classified as held to maturity, not on a whim. There must be the demonstration from the company that it has the intent and the ability to hold it to maturity, and it is holding it to maturity, not for the capital gain or any potential capital gain, but for the stream of income that it provides. And if it satisfies those conditions, well, then amortize cost, because here's the logic. You paid this much for it, you're going to get this much for it, and it will amortize to par using the effective interest rate method, which means based on the yield that you bought it, it will amortize to par over time, and you'll get exactly the par back. You will realize that yield to maturity. And yes, its fair value will fluctuate above or below, but because you have the willingness and the ability to hold it to maturity, you will list it at amortized cost because it reflects the economic reality of what you're doing, much like listing this at carrying value recognizes the economic reality of how you're using the asset. So it's not the existence of the asset, it is how you're using the asset. That's why held to maturity or hold to maturity is listed at amortized cost. Yes, there are times where there'll be this unrealized loss. But look at any manufacturing company. Pick any company that has any kind of depreciation or amortization on its income statement, and it has assets that are most likely either overstated or understated on its balance sheet based on where fair value happens to be, and no one makes a big deal out of it. Again, GM is $50 billion. Between what it depreciates and what it amortizes, it adds up to a little over $50 billion. No one's running over to GM right now saying, "Oh my God, you have assets that are overstated. The fair value of all those assembly lines and plants are way lower. We got to throw you out." This idea of running around throwing out banks today because they have a category of assets, long-lived assets called held to maturity, misses the point. We're blaming held to maturity for the bankruptcy or for the failure of the bank. That would be like blaming depreciation for the failure of a company. Well, if they wouldn't have depreciated their assets, if they would have listed their assets each year at fair value, they could have avoided all of this. How? Right? So the failure of this particular bank had nothing to do with the category of held to maturity. It had nothing to do with amortized cost. It was a failure of risk management, plain and simple. You had a 15-month vacancy of the chief risk officer position. And the question has to be asked, why did you have a 15-month vacancy? Why? Now, let's say I was going to invest in a pet food business. And they said, I looked at their management team and I see that they have a chief chemist. And I see that they have a chief health and safety officer, but they don't have a chief risk officer. I think, wow, their balance sheet doesn't really have interest rate sensitive assets, and their liabilities are probably not that interest rate sensitive, especially if they have no publicly traded debt. So I'm okay with that. That's not a critical position. But if I looked at that pet food company and I saw that the chief chemist position was vacant, and I saw that the chief health and safety position was vacant, I would say, whoa, you're in the business of making food that's going into my friend. I got a bit of a problem with that. And they point out that, yeah, but look at our chief risk officer. Yeah, but that's not critical for what you're doing. This is a bank. This is a bank, and think about the assets and liabilities of a bank. They're all interest rate sensitive. If anyone's been through the FRM program, level 1 and level 2, do you know how bankish it is? How much banking information you get? Why? Because that's the role of a bank. That is the key role in a bank. To not have a CRO, here's an interesting question. You have two banks to choose from, Bank A and Bank B. And let me write that down for you. There is B, there is A. I'm going to write them in reverse here. A has a CEO, but no CRO. B has a CRO, but no CEO. And you have to invest in one. Gun to your head, which one do you pick? I'll pick Bank B any day. I'll pick Bank B. You can have a vacant CEO position, but you better have a CRO because your whole balance sheet is nothing but risk. It's nothing but risk. to not have somebody in that position for 15 months. The question has to be asked. You can't just ignore it. It has to be asked. Why? Why would you do it? Again, you're a pet food manufacturer. You don't have a CRO. Okay. Okay. Fill it, but I'm good with that. But you're a bank and you don't have a CRO. I think right away, red flag. Why? My question would be, what happened to the previous one? Why did the previous one leave? When did the previous one leave? Who was responsible for risk management during that period of time? Because I'm led to the second point here. They have the allowable use of derivatives for hedging. It is allowed. Minimal use, though. Minimal use. The amount of in 2021, they had some hedging in place. 2022, it was pretty much all removed. Why? Well, 2022, all through 2022, they had no CRO. So maybe nobody knew how to do it. So there's some evidence here that the lack of a CRO led to some kind of conclusion, which was, look, we're not going to do it. And I don't know if that was an active decision or, well, what do we do? How do we do it? Maybe nobody had the expertise to get it done. Minimal use, and it was only on the AFS portfolio, which is expected. I think if you started putting interest rate derivatives on the held to maturity portfolio, and I'm not sure on this, maybe there's an accountant out there or an auditor out there listening, or somebody in the banking sector listening, that I think if you attempt to hedge out interest rate risk on the held to maturity portfolio, it would call into question your holding it to maturity. The idea of using amortized cost to hold it to maturity, since you're insulated from changes in fair value, why are you doing it? I think there might be something on that. But they had minimal use and only on the available for sale portfolio while they had no CRO. I think these two are related. Add to that an overinvestment in their long-term assets, which is their held to maturity portfolio. It is not the treatment, the accounting treatment of held to maturity that was the problem. It was the overinvestment in the long-term assets. Well, any company can do that. I mean, GM can do that. GM can say, well, we're going to build 10 more assembly plants. And the question would be, why? Why are you overinvesting in these fixed assets? Why are you raising your fixed cost structure? Why would you do it? Any analyst would question that. You're overinvesting in your fixed asset, in your balance sheet on your fixed asset side. Well, that's all they were doing here. They were overinvesting in the held to maturity portfolio. Again, kind of fits. You don't have a CRO. You're not using interest rate derivatives to the extent that you should. All through 2022, anybody knew interest rates were going up. You're a bank, for God's sake. And you overinvested in your long-term assets. If we look at the available for sale, other comprehensive income, unrealized loss in 2021 was $644 million. 2.5 billion in 2022. To allow that to continue quarter after quarter, minimal use of derivatives while that was going on, and maybe the motivation to overinvest in the held to maturity assets was that you wouldn't get more in your available for sale, so that you could avoid these unrealized losses in OCI. Maybe that was the thinking. Well, don't you think a risk officer would have said, whoa, hang on though, you're just introducing another source of risk altogether. So you have to point to a failure of risk management here, and you do have to ask this very, very important question. And I'm going to present you with a potential explanation which fits the evidence. Now, a lawyer would come along and say, that is all circumstantial evidence. Doesn't matter. A detective coming to a crime scene would say, it's evidence nonetheless. I must ask the questions until I get the answer. To not ask the question would seem just as irresponsible as having a 15-month vacancy on the CRO position. But I'll get to that. So let's say held to maturity is changed to fair value through OCI or fair value through P&L. So amortized cost is now gone. There, we've solved the problem. Regulation has come in and said, oh, we think it was amortized cost that was the problem. You weren't recognizing this loss. If you had to recognize it, you would have stepped in sooner. Risk management would have shown up. There we go. Problem solved. Well, let's do a little thought experiment and think about the outcome. Would there be more hedging? You would think, well, if you had to hedge everything, if everything had interest rate risk, you'd hedge everything. Well, they weren't even hedging the AFS portfolio. So if this wasn't held to maturity, if it was still fair value, do you think they would have been hedging? They weren't even hedging that. Well, more hedging, not likely, because hedges require liquidity. What if the hedges work against you? You have mark to market, you have quarterly payments. If you attempt to hedge not just a $21 billion AFS portfolio, but a $90 billion held to maturity portfolio, and this isn't even one of the big banks. Imagine the big ones. First of all, you're going to have concentration of counterparty risk. At some point, a dealer is going to say, I can't take on that much notional, especially when you get to big banks that might have $1 trillion or $1.5 trillion. But never mind that. Let's just stick with this bank, and let's say that they did the 90 billion, which was their held to maturity portfolio, and they did the 26, which was their original AFS portfolio. You got 116 billion. And let's say you hedge that out with interest rate swaps. Well, there you go. You've protected the value of it, but what if it worked against you? How are you going to meet the liquidity needs in your mark-to-market payments? You're going to have to sell stuff. So it's not likely that it would result in more hedging, because more hedging introduces higher liquidity needs. So it's not likely you're going to do that. You'd lower the duration of your asset portfolio. In other words, well, let's get rid of MBS. That has negative convexity. No U.S. Treasuries greater than 2 or 3 years. So let's just get rid of that. The financial sector is a large lender to the Treasury. Who's going to step in and lend to the Treasury instead? That hole has to be filled by somebody else. You're going to lose that clientele effect at that part of the curve. Who's going to do it? You're going to have to probably accept higher yields on Treasuries. Well, higher yields on Treasuries, higher yields on a 10-year, less demand for MBS, higher yields on MBS means higher mortgage rates. So you're going to have higher mortgage rates. You go with lower duration on your held to maturity portfolio because you now have to market to fair value every quarter. Well, that's going to move everyone to the shorter end of the curve where you get lower yield, so lower interest on deposits. Customers are going to have to accept lower yields on deposits. They're going to have to pay higher mortgage rates. And if interest rates rise, you're going to get cash flight as interest rates rise, which means you're going to get a more unstable banking sector as money leaves. Oh, but you'll get rid of amortized cost. You see, amortized cost is there for a reason. It's there to encourage the banks to take on some duration. It's there to help keep rates lower. It's there to help keep mortgage rates lower. It's there to help aid in paying higher deposit rates if you have to. So there is a reason for it. It reduces the volatility of the balance sheet, which reduces the cost of the bank. And if you can reduce the cost of the bank, you reduce borrowing costs for consumers who show up at that bank. And there's a reason why equipment in manufacturing firms is amortized over its useful life, because it reflects the economic reality. So when investors are making decisions about whether or not they want to buy into a company based on the matching principle, they can judge the profitability of that firm. It enhances the efficient allocation of capital in an economy. Yes, it has problems. Yes, it has disadvantages, but it has many more advantages. And whenever you replace a system with another system, a policy with another policy, you can't say our policy solves all of the problems of the other policy without saying, hang on a second, every single policy, procedure, system, decision has both advantages and disadvantages. Nothing has only advantages. So when you introduce something else, you have to say, well, is this going to be the outcome? If you get more hedging, you get more liquidity needs. You'll probably end up with more liquidity crisis in banking, not less. If you have duration that goes down to the very short end of the curve, get ready for higher mortgage rates, sustained higher mortgage rates in the economy, lower yields on deposits because, well, you simply can't invest for yield anymore. You have to invest for liquidity. And if that's the case, you will get cash flight as rates rise, which means you will create a more unstable banking sector. So let's not throw out held to maturity. In fact, let's not even blame held to maturity. Let's blame risk management, and let's ask this question. 15 months. So I did some reading on SVB because you got to know why you have this 15-month gap. And you learn some things about SVB. One of the things you learn is that it is a strong proponent of DEI, diversity, equity, and inclusion, which has, as I said, go back to screen one, it has its advantages and its disadvantages. Nothing has just advantages. So it does have disadvantages. It was considered a very woke bank. Well, considering the geographic location of it, it makes sense. It's in the heart of wokeness in California, in Silicon Valley. It seems to be right in the heart of it all, so adopting it isn't shocking. They had even internal prizes for who is the most wokest and who is leading the most wokest things in the organization. I have to ask the question because the CRO they did hire was a woman. Now, before you jump all over me, a qualified woman. Read her resume. Read her bio. She's more than qualified for this job. In fact, I would say this bank would have been a lot better off had they hired her 15 months ago. She is qualified for the job. I'm not saying that they hired somebody who couldn't do the job. She can do the job. She has the qualities and the background to get the job done. Yes, she does. Go. You can read her bio. It's right on the SVB site. I'm not questioning that at all. I am saying that they would have been better off 15 months ago hiring her for that position. What is unfortunate is they hired her when it was too late. And now, on top of her excellent career, she has to put this on it, that she was the CRO of this bank. And she probably had nothing to do with it. She probably walked into this saying, okay, let me think about this. Let's see, here's what we need to do. I don't know that much was done, but that may be a function of the way she was hired, which was work from home. She was based in New York. Work from home doesn't work. It doesn't work. It doesn't work. It's a pile of crap. Anybody who says, but I work better from home, no, you don't. You want to work from home. Who doesn't want to work from home? But it doesn't work. Anyways, 15 months. A woke organization, and when they hire someone, it's a woman. Is it the case that qualified candidates were available previous to this that were problematic? Maybe not from the right identity group. So maybe they held out until they could get a qualified candidate from the correct identity group. Now, a lawyer would say, well, this is all circumstantial evidence. I mean, you walk in, you see a whole bunch of woke programs going on. You see a woman being hired in a position that was vacant for 15 months, and you're putting, a conclusion together. A detective would say, this is interesting. Let me ask some questions. The big question is, why was there a 15-month wait? That has to be answered. And if it is found that there was a 15-month wait because an appropriate candidate could not be located, then we found the real culprit here. It wasn't a failure of risk management. It was a failure of culture. So it's something to think about. You can't ignore it. The question has to be asked because they're leading with it. I mean, it is on their website. They do celebrate it. They are leading with it. Now, here's the thing. If this was the chief marketing officer that was vacant for 15 months, who cares? For a bank, I would say, it would have been nice, but I don't really think it matters. I mean, they had a very captive market that probably wasn't going anywhere. You probably could have gotten by without a chief marketing officer. But for a bank to go 15 months without a CRO, the question has to be asked of why would you do it? Why would you do it? Unless you couldn't find a qualified candidate. Now, I have a hard time believing that you would go 15 months for such a critical position because you couldn't find a qualified candidate. It seems more logical that you couldn't find the appropriate, the non-problematic candidate. I don't know. I think if it were me and I were the detective at this crime scene, this would be in my little Columbo notebook going, what confuses me is this. And I'd be asking the questions until I was satisfied that, okay, I can cross this off my list. This is not a suspect. But until I can do that, this is a suspect in this crime.